Hello everyone, and welcome back to the Web3 Daily Report. Today our headline is the kind of news that absolutely explodes the entire crypto community. If I had to summarize the market action in one sentence, I'd say we're in a split personality market. Big institutions are quietly accumulating spot Bitcoin, but the overwhelming macro-political risk is keeping everyone range-bound and cautious. Let's quickly check the core assets. Bitcoin's price is holding firm, trading consistently around $109,400, and Ethereum is hovering near $3,880. We've been consolidating in this range for almost 2 weeks now. Honestly, when I first saw the data, I was a bit confused because the underlying metrics look incredibly healthy just in the last 24 hours. The spot Bitcoin ETFs recorded a net inflow of $266 million, and the Ethereum ETFs pulled in another $99 million. What does this tell us? Institutional money hasn't stopped. They are steadily and strategically buying the dip. Yet, if you look at retail sentiment, the fear index is close to extreme fear levels. This clearly suggests a structural liquidity shift is happening. So, why the contradiction? I think the key is that everyone is waiting for a clear signal. Are we waiting for the Fed's macro decision at the end of the month? Or are we waiting for a massive political event to break the deadlock? Well, the latter arrived yesterday with a huge impact, leading us straight into today's main topic: how political risk is fundamentally reshaping our industry. The number one hot topic today is absolutely a nuclear-level event for the crypto world. President Donald Trump has granted a full and unconditional pardon to the Binance founder, Changpeng Zhao CZ. My initial reaction was, this is surreal. You have to remember, back in November, CZ pleaded guilty to violating the Bank Secrecy Act for failing to maintain an effective anti-money laundering program. He stepped down as CEO, and Binance paid a staggering $4.3 billion fine. The DOJ even pushed for 3 years of jail time, though he was ultimately sentenced to 4 months and was released just this past September. But now, Trump has directly used his constitutional authority to issue a full and unconditional pardon. The messaging from White House Press Secretary Caroline Leavitt was very deliberate. She framed this as correcting the Biden administration's war on cryptocurrency. She explicitly stated that the Biden administration prosecuted Zhao despite no allegations of fraud or identifiable victims, solely to punish the cryptocurrency industry. This instantly politicizes a major criminal case, turning it into a political persecution narrative right before a US election. The real controversy here isn't legal. It's political and centered on potential conflicts of interest. Democratic senators like Elizabeth Warren immediately condemned the pardon as corrupt behavior. Why? Because reports surfaced indicating that World Liberty Financial, a crypto venture backed by the Trump family, and its stablecoin $1 were involved in a $2 billion investment deal in Binance by an Abu Dhabi firm, while Trump himself claimed he doesn't even know CZ, stating the decision was based on strong recommendations from many people and even implying CZ didn't do anything wrong. The timing and connections raise serious questions about the integrity of the U.S. justice system. Then, look at CZ's response on X. He thanked Trump and pledged, "We'll do everything we can to help make America the capital of crypto and advance Web3 worldwide." When he says that, the whole community starts speculating, is this, in effect, a high-level political trade? For me, the implications of this event are threefold and profoundly significant. First, the authority of regulatory enforcement has been completely politicized. CZ's case was supposed to be the gold standard for AML enforcement against major global platforms. By the Trump administration framing him as a victim of political persecution, the deterrence power of the DOJ and the Treasury Department for future crypto enforcement is severely undermined. This signal could embolden other companies to test the compliance boundaries. Second, cryptocurrency has formally become a major US political bargaining chip. This event thrusts the crypto industry squarely onto the presidential election debate stage. Pardoning CZ, following the previous pardon of Ross Ulbricht, is a clear and high-profile appeal to the crypto voter base by Trump. Crypto is no longer just a technical or financial issue, it is a highly politicized component of the electoral landscape. This has both positive and negative aspects for the industry. It gains high-level attention, but its policy direction will become much more susceptible to radical swings based on political cycles. Third, it could create new challenges for Binance's governance and international reputation. CZ remains Binance's majority shareholder. While he denies interest in returning as CEO, the pardon essentially removes his primary legal obstacle to exerting influence. But in highly compliance-focused jurisdictions like Europe under the MiCA framework, international regulators may question the credibility of Binance's compliance commitments if the US government can so easily overturn a criminal conviction for AML failures. In short, this event deeply intertwines politics and crypto. We can no longer view the market as being solely influenced by technology and macroeconomics. Political risk is now the biggest risk premium. Next up, let's dive into the major news stories. I've filtered 6 of them that I believe have a long-term impact on our industry. The crypto sector spends hundreds of millions of dollars annually lobbying in Washington, all for one thing: regulatory certainty. Yet, the most desired piece of legislation, the Digital Asset Market Structure Bill, our industry's #1 wish, has completely stalled in the Senate. I heard that this Wednesday, many heavy-hitting executives from our space rushed to Capitol Hill for emergency meetings, desperate to rescue the bill, but those who left the discussions were deeply pessimistic. One official explicitly said that passing the bill this year would require a miracle. This means the timeline for resolving this legislative issue is highly likely to be pushed into next year. Bipartisan talks in the Senate stalled early this month due to public disputes. The core issue here isn't crypto itself, but the turf war within the US federal government. Senator John Kennedy was very frank on the Senate floor. He said, the legislation is necessary because the Securities and Exchange Commission and the Commodity Futures Trading Commission, CFTC, are fighting over turf. They don't know who should regulate Bitcoin versus other digital assets. He stated that industry leaders are confused about which department of the government they should even be talking to. Congress's role was to step in and draw a clear line, but they themselves are now stuck in the mud. What does this gridlock mean for us? I believe it indefinitely extends the regulatory uncertainty risk premium hanging over our industry. Every day it's delayed the regulatory agencies, especially the SEC, get another chance to define assets through enforcement actions, rather than clear rules. Senator Kennedy admitted this is one of the most complicated pieces of legislation he's ever seen. This suggests that even with the will to move forward, Congress prefers to move deliberately, that is, slowly. This slow pace is completely counter to the industry's desire for speed and breakthrough. So, folks, we need to prepare ourselves to push back the expectation of legislative success until next year. This kind of political uncertainty is undoubtedly a significant macro factor, suppressing current market sentiment. Okay. Let's move on to the second piece of news. While everyone is focused on political bickering in the US, Europe is moving fast. The fintech giant Revolut has officially secured its license under the Markets in Crypto Assets regulation. They didn't just get the license, they immediately announced a massive expansion of their crypto services across the entire European Economic Area and the launch of a major initiative called Crypto 2. When I saw this news, I realized Europe is genuinely stepping ahead of the global curve in terms of regulatory clarity. Revolut obtained a MiCA license through its Cyprus entity. The brilliance of this license is that it acts as a regulatory passport, allowing Revolut to offer regulated crypto services across all 30 EEA countries, significantly cutting their cross-border compliance costs. Officials from the Cyprus Securities and Exchange Commission (CySEC) have affirmed that granting the license reflects their trust in Revolut's regulatory standards. So, what's the plan for Crypto 2? Revolut aims to deepen the user experience. They plan to expand the number of tradable cryptocurrencies to over 280. More aggressively, they've promised to introduce zero-fee staking services and zero-spread conversions for USD stablecoins. These features are a direct head-on challenge to traditional crypto exchanges like Kraken. What's the core takeaway here? Revolut is a digital bank with millions of users. Its rapid expansion under the MiCA framework signals that traditional finance TradFi giants are integrating crypto services as a core product line, not just a side gig. The commitment to zero-fee staking and zero-spread stablecoin conversion suggests that, fueled by regulatory clarity, the competitive focus in the European market is shifting from availability to quality and cost efficiency. Therefore, while the US squabbles over jurisdiction, Europe has established a rapidly deployable, cost-effective operating hub for global crypto enterprises seeking regulatory certainty. This regulatory competitive edge will undoubtedly have a profound long-term impact on global capital flows in our industry. Okay, let's continue with the third piece of news. This news highlights that large institutions are rapidly embracing both decentralized finance and real-world asset tokenization. However, this integration isn't smooth sailing. especially as it faces systemic risk warnings from core US financial regulators. First, let's look at DeFi. Aave Labs recently acquired Stable Finance. Stable Finance previously specialized in a mobile app for stablecoin savings, focused on a simple interface for novice users to easily earn interest. Aave Labs plans to integrate these user-friendly features into its new on-chain savings products, aiming to lower the barrier for average retail users to enter DeFi. This is essentially Aave Labs' two-track strategy. They launched Horizon, an institutional platform back in August, which now holds over $300 million in deposits. Now they are focusing on refining the retail user experience, ensuring that DeFi doesn't lose its decentralized spirit, serving everyone even as it embraces institutions. However, when these assets, particularly RWA tokenization, seek large-scale entry into the core US financial system, they run into trouble. Officials from the US Federal Reserve have recently voiced concerns. They worry that allowing non-bank institutions, such as stablecoin issuers, into the core payment system could introduce new systemic risk channels. Fed officials specifically warned that the risk of a stablecoin run could directly impact the stability of the entire payment network. Treasury officials quickly chimed in, emphasizing that granting stablecoin institutions access to the payment system does not equate to granting them the same status as banks. What is the central point of this news? It reveals that the core resistance RWA faces in Washington isn't a technical issue of can it be tokenized, but a deeper regulatory concern about financial control and risk transmission mechanisms. The Federal Reserve views RWA integration more as a conditional integration experiment rather than a full endorsement. This restriction limits the global circulation and speed of RWA adoption, which will continue to rely on coordination and compliance certification from multiple national regulators before it can truly enter the core of mainstream finance. So when you focus on RWA, be aware that while the technology is advancing, the timeline for clearing the hurdle posed by the Fed might be extended. Alright. The fourth piece of news. While the entire market is stuck in sell the growth mode with dampened sentiment, Google suddenly announced that its Willow chip has achieved what they call quantum advantage. This technological milestone, although distant for the average user, acted like an alarm bell, reigniting the old anxieties within the community regarding the fundamental cryptographic security of Bitcoin. Many of you likely know that Bitcoin's security foundation relies on the elliptic curve digital signature algorithm, or ECDSA. Theoretically, future quantum computers could use Shor's algorithm to crack this, directly threatening the immutability of the Bitcoin network. The key takeaway here is not the technology itself, but the fragility of the market narrative. The market currently lacks clear positive narratives, and the sentiment is low. In this environment, a distant, theoretical, technical threat gets amplified, becoming a factor that disturbs short-term trading sentiment. It reminds traders just how fragile confidence can be when everything else feels tired. But we must also be rational. Achieving the stable, fault-tolerant quantum computer capable of cracking Bitcoin is still far off in reality. However, Google's breakthrough serves as a powerful external stimulus, signaling to the Web3 community and core developers that research and implementation of post-quantum cryptography must now be prioritized strategically. Maintaining the long-term security of the Bitcoin network requires developers to stop waiting and immediately start planning upgrades to quantum-resistant algorithms, even if it's just establishing a clear defense timeline. So this news essentially converts a potential future threat into an operational risk that requires current planning, and it's something everyone in the industry needs to be alert to. Alright, here is the fifth piece of news. One of the world's leading crypto exchanges, Gate, recently released its Q3 2025 transparency report. This report is highly significant because it not only showcases impressive growth, particularly in the derivatives market, but also reveals a strategic plan for a future L3 architecture. I believe this represents the direction of computation for top exchanges in the coming years. Let's look at the numbers first. The report shows that Gate's derivatives market share has climbed to 11.3%, securing its position as the second largest derivatives exchange globally. Compared to last year, their spot trading volume grew nearly 200%, and derivatives trading volume surged over 10%. This explosive growth is clearly not luck. It's the result of massive upgrades to their matching engine, market-making processes, and institutional liquidity provision. This successfully attracted a significant number of professional traders and high-frequency trading environments. What catches my attention even more is their ecosystem infrastructure strategy. Gate now has over 41 million users who are the core of their all-in Web3 initiative. Beyond trading volume, their GUSD stable yield product has also been a massive success, with issuance exceeding $230 million in a short period. The clever part about USD is that it offers a layered yield structure that can be combined with products like Launchpool, effectively locking user funds within their own ecosystem and greatly enhancing platform stickiness and liquidity. But the truly noteworthy disclosure in the report is about their future architecture. Gate explicitly mentioned that their current L2 chain records execution and settlement data. However, they plan to introduce a future L3 layer to further enhance data integrity and immutability. What is the concept of L3? It's typically a customized execution layer tailored for specific applications or needs, representing a higher performance architecture than existing L2 solutions. Gate's L3 plan signifies its pursuit of building a highly optimized auditable layer for trading and financial services, designed to meet the highest demands of future institutions regarding data security and compliance. This is a strategic shift from a mere trading platform to a comprehensive ecosystem infrastructure. In summary, the competition among top exchanges has entered the infrastructure battle. Whoever can move faster on trading experience, ecosystem stickiness, and technical architecture will secure future institutional flow. Gate's L3 plan reveals the next frontier of this competition. That concludes today's Web3 Daily Report. If you found this helpful, please remember to hit that like button to support us. We are here every day, filtering the core information in the Web3 world that is most relevant and closest to generating wealth. We hope that this curated summary of content helps you make more rational and informed decisions on your Web3 investment journey. Additionally, I've prepared exclusive registration links for major exchanges in the comment section below. These are high rebate offers we secured for our fans, aiming to save you some costs on your investment path. Let's stay rational, move steadily, and get rich slowly in the Web3 world. May all of your crypto assets grow steadily. We'll see you tomorrow.